Yes.
Maybe you could give a short introduction about your fund. I think that's useful.
Yes, by all means. Yeah. So we are Evenlode Investment. We're a fund manager based in Oxfordshire in the United Kingdom. We manage two portfolios at the moment, or two strategies. One is a UK equity income strategy, and the other is a global income or dividend strategy that we launched in November 2017, which is managed by myself and Chris.
How long does your fund exist?
So we launched the Evenlode Income Fund, which is the UK fund, in 2009. So we've just celebrated our 10th anniversary.
Okay, okay. But this fund only invests in UK companies?
It's predominantly UK listed companies, and then the fund, the Global Income strategy that we launched in 2017, invests globally. So it's,
Globally, yeah, okay, okay. And that's mostly a dividend fund, I think?
That's correct, exactly. So our focus is on dividends and dividend growth.
Oh, okay, okay. And can you say something about your historical performances?
Yeah, the historic performance has been good. The global strategy is global income strategy is benchmarked to the MSCI World, and we've been ahead of that since launch. Obviously, it's been quite an interesting time to be managing that portfolio through the coronavirus crisis, but the portfolios held up very well, particularly against other income strategies.
Okay, so your fund is a dividend fund. Many investors in general would say that's a nice free lunch, but of course it can be a value trap many times. How can you, or could you give me maybe some most popular warnings for investors to avoid value traps? Because high dividend return always seems like a very nice opportunity, but the lower the stock price, the higher the dividend return.
Absolutely. So our focus is on looking for companies that have good competitive positions and strong free cash flows, and that's very important when it comes to dividends, because if a dividend is not covered by by free cash flow, then ultimately it can't be paid. So we look for good free cash flow cover on the dividend. We look for companies that have strong competitive positions, so that free cash flow can be maintained into the future and pay a stable and ideally growing dividend.
So is free cash flow the most important or dominant factor in your investment process?
Yeah, Chris?
Yeah. So yes, basically the ability to generate strong free cash flow from a sort of limited asset base is definitely a must-have for an Evenlode stock. What we look for is, say, high cash flow returns on assets, because that really drives a virtuous cycle for the company. When you get an asset base that generates lots of excess cash flows, you can either choose to invest that back into the business and in turn generate more cash over time and providing an engine for growth, or that cash can be returned to the investor, as Ben said, in the form of dividends, ideally. Just in terms of other characteristics that we look for, obviously mentioned cash flow generation. We spend a lot of time thinking about some of the sort of probably softer elements of investment. So particularly pricing power is very important to us. And what we want is companies where the first question from the customer is not how much will this cost, but instead what benefits am I going to get from this product or service, or even how can I afford to operate without this? Because companies with strong pricing power are generally better able to ride out the economic cycle.
Okay, and do you have different investment analysis for different sectors, more or less? I think for financials, many investors or just even avoid financials. But do you have the same criteria for the other sectors?
Yeah.
Sorry,
go on, Chris.
So we are open to investing really in any sector, but there are certain sectors where you're more likely to find companies that have either basically high returns on the asset base, or very strong pricing power, or good intangibles. And that tends not to be the very resource heavy companies where, for example, if you're an oil company, you don't get to set the price of oil.
Yeah. And do you also invest in many micro caps or small caps?
No, we have a limit on the companies we invest in. So we only consider companies that have a free float of over £1 billion sterling.
Okay, so these are mid caps, I think.
And above.
And above, yeah, okay, got it, okay. Do you also speak with the managements of the companies?
Yeah, we certainly do. What we want from the management teams of companies is obviously an update on current trading, but very importantly, we're long-term investors fundamentally. And what we are looking for is a picture of current performance, but in the context of the overall business's strategy, how the business is being invested, very importantly, in the future. So investing in things like research and development, capital expenditure, and so on. And we want to go to management teams with a list of questions and not be given a sales pitch. So it's very important to have that element of having our critical faculties switched on when we meet management teams. But we also interact with companies on from a governance perspective. So we do have a stewardship analyst who looks to address sort of governance matters. Obviously, remuneration's been a very big topic recently, but also other things like sustainability and the environmental agenda has become very important over the last few years to our investors and to companies themselves. So we engage on those sorts of matters as well.
Okay, and are there also in your fund any non-dividend companies?
There aren't any non-dividend payers. There's a spectrum of yields from sort of just under 1% to sort of around the 4% level, but there aren't any non-payers, no.
So there are some companies that don't pay out any dividends in your fund, or is it a fixed criteria to pay out?
They all pay.
They all pay. Oh, okay. Do you see a lot of impact? Of course, I think for the COVID crisis, also for your investment process, maybe, or did the world change a lot?
Yeah, so we have had some dividends that have been postponed. We expect them all to come back, but some companies are rightly saying we'll take a view on the dividend until later in the year, particularly those in more cyclical industries such as recruitment, and we think that's a very sensible idea. What we are interested in is the success of companies over the long term, and we don't want companies to keep on paying a dividend if it's going to make the long term for that company.
And do you also invest in financials? Just the banks?
We have a couple of financial holdings, but they are much more things like Euronext, the exchange operator.
Okay.
We don't invest in banks. We don't invest in insurers, which are obviously two sectors.
Oh, you don't? Okay. Yeah. Okay, got it. And do you also invest in emerging markets? Big companies there?
So we don't preclude emerging markets. Predominantly, we invest in companies which are developed market listed, but that doesn't stop us from having good exposure to the underlying emerging economies. For example, you take a company like Unilever, a large amount of their revenues are generated in Southeast Asia and emerging markets around the world. And investing in large developed market companies with emerging market exposure is quite a nice way to make sure you have good diversification as well.
Yeah. Okay. And do you have some predictions or expectations for the coming years for the investment world? Do you think that your process will be the same, or do you have any new criteria that you recently developed?
We're pretty happy with the investment process. It's served us well so far. So I don't think, we're not going to be changing our investment process. In terms of predictions, I think we generally try and stay away from making predictions. What we want are companies that can survive really whatever happens. So with strong cash flows, a responsibly managed balance sheet, and with a sustainable competitive advantage.
Okay, so to summarize, you're almost 100% bottom-up fund?
Yes.
Okay, so you mostly ignore the macroeconomic influences, I think?
I mean, you can't completely ignore them. These are the macroeconomy, the global economy is where we operate. You need to understand what is driving the results and the conditions in which company operates. But we really want high quality companies that can operate across a range of different outcomes.
Okay, got it. Okay. Do you have anything to add maybe, or other nice things, or I think we discussed most of the points, I think.
Yeah, I think just really the fundamentals of free cash flow and free cash flow growth are obviously, they're going to stay for us, but they're obviously taking a bit of a knock in the coronavirus crisis. What's important to us is whether a company can sustain its free cash flow and dividend in the long term, and certainly we feel that that's the case for the portfolio and the dividend strategy. So
one last question, in case you are very positive about a company with great growing free cash flows, but it has extremely high price earnings ratio and doesn't pay out any dividends, will you still consider to buy it, or just
we do value all of the businesses in our investable universe using a fundamental free cash flow based valuation methodology. So we do take that into account. If the company looks very expensive, then we're unlikely to invest in it. We will look for the best combination of quality and value.
And your view about the free cash flow, I think you partly look at the historical trend in the free cash flow, but you also make some predictions, of course, and then you combine it, I think.
Yeah, so when we look at the free cash flows, we project the cash flows forward based on the qualities we see in the company. We assume all companies will see their rate of growth of free cash flows decline pretty quickly. So we take a generally quite conservative view. But yeah, we do project it forward based on the quality we see in the company. So a company that generates, for example, lots of cash flow from repeat purchase sales, say a company like a Pepsi or a Unilever, are likely to have a longer delay to the fade in cash flow growth.
Okay. I don't have anything left to ask. Okay, thanks for the interview.
Thank you very much, Robert.
If I got questions, I will let you know.
Okay.
Right.
Okay, have a nice day.
You too.
Thank you. Bye-bye.